You walk into a payday loan store on Wednesday because you need $400 before Friday. Maybe the transmission warning light turned into a repair bill. Maybe rent cleared 2 days earlier than you expected. Maybe a utility company has given you 48 hours before it shuts something off. Whatever happened, the problem is not theoretical. It is sitting in front of you right now, and the lender has a remarkably simple answer. $400 today, a $60 finance charge, and $460 due around your next payday. Painful, but manageable. At least that is how it feels when the alternative is not getting to work tomorrow. Except there is a problem hiding inside the transaction. If you needed to borrow $400 because you were already short of cash, where exactly is the extra $60 supposed to come from 2 weeks later? That question is more important than the interest rate, because it explains why payday lending can look like the easiest business in finance from the outside and still be much stranger once you follow the money. The obvious headline is the APR. A common payday loan fee is around $15 for every 100 borrowed. On a 2-week loan, that works out to an annual percentage rate approaching 400%. So $400 can become $460 in roughly 14 days. Put those numbers beside a normal credit card or bank loan and the difference looks almost absurd. And that is usually where the story ends. The lender charges an enormous rate, the borrower pays it, and the store pockets the difference. But APR is not profit margin. It annualizes the cost of a very short loan, so different forms of credit can be compared on the same scale. The lender still has to fund the cash it advances, pay employees, rent a storefront, process payments, comply with state law, absorb fraud, chase failed payments, and write off loans that never come back. A 400% APR tells you the credit is expensive. It does not tell you the owner of the store is keeping 400%. So before we call this a business built on one giant number, look at what one actual loan has to do. The lender advances $400. If everything works, $460 comes back. That $60 is the gross revenue attached to the transaction before the rest of the machine gets paid. There is no warehouse, no complicated physical inventory, and no product that can be marked up because a customer likes the color. The money itself is identical every time. The variable is the person receiving it. That makes payday lending a strange kind of retail. A restaurant worries that food will spoil. A tire shop worries that the wrong size will sit in inventory. A payday lender worries that the thing leaving the building will not return. Traditional payday loans are typically small, short-term loans, often due on the next payday, and repayment commonly involves a post-dated check or authorization for the lender to debit the borrower's account. The product is designed around one assumption: income is coming soon. The lender is not lending against a house or a car sitting in its parking lot. It is lending against the expectation that money will hit an account in the near future. And that tells you who the ideal customer is. It is not the richest person in town. Someone with savings, unused credit, and a bank willing to lend cheaply has no reason to pay $60 to borrow $400 for 2 weeks. But it is not someone with no income at all either, because a lender cannot build a repeatable business around customers who have no realistic way to repay. The valuable customer sits in the uncomfortable middle, short enough to need the money, but stable enough to have a paycheck coming. That is the first thing most people get wrong about the model. The lender does not need a customer who is completely broke. It needs a customer whose finances are almost working. There has to be income, there has to be a shortage, and the distance between those two has to be small enough that a few $100s can bridge it. Before we follow that bridge, tell me about the most expensive emergency you have ever had arrive at the worst possible time. Car repair, medical bill, rent, anything. I am interested in the timing more than the amount, because timing is where this entire business lives. And if you enjoy seeing ordinary businesses pulled apart like this, liking and subscribing genuinely helps these videos reach more people. Now go back to Wednesday. The borrower is not comparing this loan with some perfect financial product that exists only in a spreadsheet. They may be comparing $60 in fees with missing a shift because the car is dead, paying a late bill, bouncing several payments, or going without something they need immediately. That distinction matters because consumer finance is full of products that look irrational if you compare them with the cheapest, theoretical alternative, and completely understandable if you compare them with the actual alternatives available to the person standing at the counter. The CFPB itself advises borrowers to compare payday loans with alternatives such as employer or community assistance, lower-cost bank or credit union products, available credit cards, or negotiating directly with the creditor. Payday lenders sell speed, certainty, and a very small amount of money at the exact moment those three things are unusually valuable. The problem appears when the calendar moves forward. Suppose the borrower normally brings home $1,600 on payday. Before taking the loan, that $1,600 already had jobs, rent, groceries, utilities, fuel, childcare, insurance, minimum payments, maybe another bill that was pushed from last month. The borrower was $400 short because those obligations were already larger than the cash available before payday. Now Friday arrives and $460 goes to the lender. The emergency from Wednesday has been solved, the car runs, the lights stayed on, the rent got paid. But the household did not create $60 of new income. It simply moved $400 from Friday into Wednesday and paid $60 for the privilege. Friday is now smaller. That is the mechanism. A payday loan can solve an immediate timing problem without solving the underlying cash flow problem that created it. If the shortage was truly one-off, that may be the end of the story. The borrower absorbs the fee, adjusts the next couple of weeks, and never comes back. But if the shortage was structural, the loan can create the conditions for another shortage. This is where the word sequence becomes more useful than APR. In states where rollovers are permitted, a borrower who cannot repay may be allowed to pay another fee and push the due date forward without reducing the principal. In other situations, one loan is repaid and another follows shortly afterward. The legal form varies, but economically the important question is the same. Did the first loan end the need for short-term credit, or did it simply move the need to the next pay period? When the CFPB studied more than 12 million storefront payday loans in historical data, it found that more than 80% were rolled over or followed by another loan within 14 days. More than 60% of the loans in that dataset occurred in sequences of 7 or more loans, and roughly half occurred in sequences of 10 or more. Those figures came from research published in 2014, so they are not a live snapshot of every borrower today, but they show why regulators and lenders both care so much about what happens after loan number 1. One loan is a transaction, a sequence is an economic relationship. Take the original $400. One successful loan produces one $60 fee. If the borrower repays and leaves permanently, the relationship ends. If another shortage appears 2 weeks later and another similar loan is taken, another fee-producing event begins. The lender does not need one contract to remain open forever. The customer's recurring cash flow gap can keep generating new contracts. That is the real engine, not default, but repeat repayment. This distinction matters because payday lending is often described as though the lender wins when the borrower collapses. But if $400 leaves the store and never comes back, the lender has not discovered a wonderful new profit center. It has lost principal. Collections, failed debits, or legal remedies may recover some of it depending on the circumstances. But a customer who simply disappears is not the ideal result. The better customer, economically, is the person who pays, then needs the product again. That produces the central contradiction inside the business. The borrower must be financially stressed enough to need expensive short-term credit, but financially stable enough to keep satisfying the lender. Too healthy, and they graduate to cheaper options or stop borrowing. Too distressed, and repayment breaks. The business lives in the narrow space between those two outcomes. And once you understand that, the storefront itself starts to look less like a bank and more like a machine built around timing. There is little to display because there is no physical product. The store needs funding, staff, compliance systems, payment rails, underwriting rules appropriate to the product, and customers whose expenses have arrived before their income. There is another reason repeat behavior matters that has nothing to do with morality and everything to do with fixed costs. A storefront can open at 9 in the morning, whether 5 borrowers arrive or 50. The rent does not fall because Tuesday is quiet. The employee behind the counter still has to be paid. The compliance software, licensing, security, banking relationships, and payment systems do not become cheaper because the neighborhood had a good week. A business making $60 of gross revenue on one $400 advance therefore needs either enough successful loans, enough repeat volume, or some combination of both to cover a cost base that keeps running regardless of how many emergencies happen that day. That makes customer acquisition unusually important. The first transaction has to pay not only for the risk of the money leaving the store, but also for the machinery required to put the loan on the books. A returning borrower is different. The lender already knows the person, already has a payment history, already has the relationship, and does not have to persuade a completely new customer to walk through the door. The economics of a repeat borrower can therefore be more attractive even before another finance charge is considered. And the capital itself has a clock attached to it. $400 sitting unused produces nothing. $400 advanced and successfully repaid can be lent again. The faster the lender can recycle the same pool of capital through borrowers who actually repay, the more productive that capital becomes. That does not mean every lender earns extraordinary returns. Defaults and operating costs can destroy the apparent spread quickly. But it explains why the business cares so much about both repayment and repetition. The money has to come back before it can earn again. Money is not the scarce object inside the transaction, time is. That is why the fee can look small and enormous at the same time. $60 sounds very different from 400% APR, even though both can describe the same 2-week loan. The borrower experiences the $60. Regulators and economists often focus on the annualized rate because it allows comparison across forms of credit. Both views are valid, but they answer different questions. The borrower is asking whether they can survive this week. The APR is asking what credit this expensive looks like when placed on the same annual scale as other loans. The lender is asking something else entirely, whether the customer comes back. That is the number hiding behind the number. And it is why payday lending becomes controversial even when the first loan solves a real problem. If a product marketed as short-term emergency credit repeatedly becomes part of a borrower's normal cash flow, the economics have changed. The lender may still be making short contracts, but the customer is living inside a long sequence. The CFPB's historical study found that only 15% of borrowers in its dataset repaid all payday debts when due without reborrowing within 14 days during the study period. 20% defaulted on a loan at some point, while 64% renewed at least one loan. Again, those are historical findings rather than a claim about every borrower today, but the pattern explains why policymakers stopped treating repeat borrowing as a side effect and started treating it as a central feature of the debate. This is also where the simple villain story becomes less useful. A payday lender did not break the transmission, it did not set the rent, it did not choose the borrower's wage. There are situations where having $400 right now can prevent a much larger immediate loss. If the alternative is losing a job because the car cannot be repaired, the fee may be expensive and still be rational. But the loan has a limitation that no marketing language can erase. It can move purchasing power through time. It cannot create income. If next Friday was already fully spoken for, pulling part of it into Wednesday leaves less of Friday available when it arrives. That is why the product can be useful and dangerous at exactly the same time. And it is also why regulation is not some outside force hovering over the business. Regulation is one of the inputs. Payday lending varies heavily by state. Some states permit it with caps on fees and loan sizes. Others restrict renewals or rollovers. Some do not permit the traditional payday model at all, or allow pricing that causes lenders to choose not to operate there. Change the law and the customer's emergency can remain identical while the business model changes completely. There is an unusually clear federal example. Active duty service members and covered dependents receive protections under the Military Lending Act, including a 36% military annual percentage rate cap on covered consumer credit. Same type of emergency, same need for a few $100s, but a radically different permissible price because the law treats that borrower differently. That tells you how dependent the traditional storefront model is on the rules around it. The federal framework has shifted too. The CFPB's payday lending rule retains payment-related provisions concerning repeated attempts to withdraw funds after consecutive failed attempts, and the agency's payday rule compliance materials were updated again in June 2026. That uncertainty matters because this is a business where the rulebook can alter the economics almost as quickly as the customer's paycheck does. So what happens when regulation squeezes the old product? The need does not disappear. The rent is still due on Thursday, the car still breaks on Wednesday, the employer still pays on Friday. The market changes shape. Some borrowers may look to other small-dollar credit products, bank or credit union alternatives, credit cards where available, employers, community organizations, friends or family, negotiated bill payments, or simply delaying another expense. The storefront can change while the underlying timing problem survives. And that may be the most important thing to understand about payday lending. It is easy to look at the lender and think the product is $400. It is not. The $400 is just the object moving across the counter. The actual problem being solved is that one date arrived before another. The expense is here. The income is not. The lender steps into the space between them and charges for the bridge. That also explains the customer it wants most precisely. Not someone who can never pay, not someone who never needs help. Someone with enough recurring income to make repayment credible and little enough slack that timing problems continue to matter. The business is therefore built around a very uncomfortable form of predictability. The paycheck must keep coming, the shortage must keep appearing, and the borrower must keep believing that the cost of moving the problem forward is better than dealing with the problem today. Go back to the original Wednesday. You walked in thinking you were buying $400, but the lender already had the $400. It did not manufacture money for you. What it manufactured was permission to use Friday's money before Friday arrived. That is what the $60 fee purchased. Not cash, but time. 2 more weeks before the shortage had to be fully absorbed by your own budget. If those 2 weeks were enough, the loan did exactly what a short-term loan is supposed to do. The emergency passed, the balance was repaid, and the relationship ended. If those 2 weeks were not enough, the calendar created another opportunity, another due date, another shortage, and another decision about whether solving today is worth making tomorrow smaller. That is how payday loan stores make money, not simply by charging enormous interest on tiny loans, and not by hoping every borrower defaults. They make money by putting a price on the gap between when expenses arrive and when income follows, then operating at the point where that gap is small enough to finance but common enough to repeat. The most valuable thing in the store is not the cash behind the counter. It is the calendar, because the product was never really $400. It was 2 more weeks. And the business becomes most powerful and most controversial when 2 more weeks still are not enough. If you enjoyed pulling this business apart, liking and subscribing helps more than you might think. See you in the next one.